Hi everybody, welcome back to Ox Talks. It is Wednesday, January the 10th, 2024. We're at the middle of the week. Hope you're having a productive day today. As always, I want to thank you for taking your valuable time to watch these videos. I really appreciate you being here. If you haven't already subscribed to the channel, please hit the subscribe button. Please hit the like button on the videos, the bell notifications, and most importantly, continue to share these videos with your family, friends, colleagues, co-workers in our continued endeavor to wake people up. Things are continuing to slide. I'm going to share a couple articles with you today talking about the continued ongoing banking collapse and the continued ongoing collapse with commercial and more importantly office real estate. And then we'll touch briefly on the CPI analysis, which is going to be coming out tomorrow morning, which we'll see how this has an impact on the markets, on the gold and silver, on the 10-year. So a lot going on. Again, thanks for being here. I apologize for not responding as I usually do to many of your comments from the last video or so. It's been kind of hectic around here at the office, dealing with a bunch of projects, and I haven't had as much time to click through those. Also, you guys are leaving more comments, so I do it. That means a lot to me. I appreciate it. This morning I went on a 12-hour fast last night because I had just some routine blood work done this morning. Every once in a while, from my perspective, I think it's smart to get a baseline of where you're at. So I go in and get all the panels done, cholesterol panels, the lipids, all that kind of stuff. Organs, check everything out, to make sure that everything is going appropriately. Sometimes a friend of mine said the other day, it can look really spiffy on the outside, but sometimes it doesn't tell the whole story about what's going on the inside. I'm in a high stress job. My blood pressure always has tended to run a little hot. So I got to keep a watch on that. I don't want to start getting involved in taking medications. That's why I exercise and keep the weight off. But anyway, it's something you guys might want to consider. I went in and got the full panel done. It's easy to do. And then it gives you a reading on kind of where you're at. If you have to make some adjustments, you can make the adjustments. So a couple things I saw today. One is a story out of Reuters, which I wanted to share with you. It was posted, I think, late yesterday in the day. And we're talking about this ongoing banking crisis. Nothing has been averted. The banks have simply been tapping into the Fed's repo facility to bridge funding gaps. This article out of Reuters says U.S. banks' profits to shrink as they brace for souring loans. It's out of New York. It says U.S. banking giants are expected to report lower profits for the fourth quarter after they set money aside to cover souring loans while also paying more to depositors. Means people are going to start, the banks know the loan defaults are going to start accelerating. The banks know that the flight of capital from their institutions is going to start accelerating. And so they're trying to hedge this off. They're trying to provide and to address this the best they can now. It says the largest bank's net interest income, the NII, or the difference between what they earn on loans and pay out on deposits, probably fell on average 10% in the fourth quarter, Goldman Sachs analysts said. An estimated 15% decline in trading revenue will also weigh on earnings, they said. Banks' profits will likely be squeezed as they set aside more reserves in the fourth quarter to prepare for customers to default on their loans. Prepare for customers to default. They know what's coming. It says profits could also be curbed by banks paying more to keep depositors' money in their accounts. So do not think for a second that what started to unfold last year with the failure of a couple of banks is not going to reaccelerate in 2024. I believe it absolutely will. You're going to see more pressure, obviously, on the mid-sized banks, obviously that have overextended on loans, that have had also their portfolios decrease in value as a result of rising interest rates. Because Bank of America's earnings per share, EPS, are expected to drop 23% in the fourth quarter versus a year earlier, while EPS at Citigroup and Morgan Stanley will fall 25% and 17% respectively, according to analyst estimates. Those are substantial drop in profits. Look, do I feel sorry for the banks? No. Do the banks continue to squeeze all of us with fees and other hidden costs? Absolutely. So no, I'm not playing violin for the banks. I'm just reporting to you that this seems to me to be an ominous warning of what the banks know is on the way. It says the health of the U.S. consumer is also in focus as lower income customers fall behind on payments in greater numbers. Although delinquencies are increasing, the strong job market has kept a lid on loan defaults, according to this one person. I don't agree that the job market is strong. We know, I've done some other videos on this. We know that the wages are not keeping pace with inflation. We know that the jobs report really talked about people having to have multiple jobs. Full-time jobs are being cut in the droves. So looking ahead, the slide in NII in the fourth quarter could extend into the first half of this year as banks tighten their lending standards while lower income consumers' finances become increasingly stretched, according to Goldman Bank analyst Richard Ramsden. So let's break that down a bit. Banks are going to tighten their lending standards. What does that mean? Well, to you and I, what that means is if we need to get a loan for something, the banks are going to be much more reticent to lend money out. They're going to be looking for A-plus credit. Impeccable credit scores. They're going to be looking for low debt to income ratios, meaning that your debt levels are under control. So look, we've talked about this all the time. You have to start, if you're not already doing it, working on improving your credit score. Make it the best it possibly can. Pay your bills on time. Don't run large balances on your credit cards. Start shoring up your resources, paying off debt, and working on your credit score, because when the opportunities start to unfold in the coming year or two, you're going to need a strong balance sheet or a clean balance sheet for sure, and you're going to also need an excellent credit score. The bank simply will not lend the money. So I thought that was an interesting article to share with you today. What we saw last year with the banks is just a precursor of things to come, in my opinion. We talked about this as well. You need to be diversifying your deposits. Don't just use one bank, and certainly don't keep any amount of funds in the banks that exceed the FDIC limit. Okay, be smart about this, and don't you can't solve this problem after your bank collapses. So do it ahead of time. It's just common sense planning. Next article from the Zero Hedge. Came out yesterday late in the day. It says office vacancies hit record high across U.S. cities as CRE downturn worsens. CRE being commercial real estate. We've talked about this before. It's been all over the news last year as well about the vacancies. But I wanted to share this with you because this impacts the banks that are holding the loans on these properties. Says new data from Moody's analysts shows that 19.6% of office space across major U.S. metro areas was not leased as of the fourth quarter of 2023, exceeding the previous high of 19.3% in the commercial real estate downturn between 1986 and 1991. So we have to go back to over 20 years, over 30 years to get to the level where this high of a level of vacancy in commercial office space. That is an amazing statistic. It says in a previous report, the Mortgage Bankers Association found that $117 billion in CRE office debt needs to be repaid or financed this year in 2024. This debt is concentrated in certain cities like New York City, Manhattan, San Francisco, Chicago, and Los Angeles. And the article breaks down the U.S. cities with the largest commercial mortgage debt. First is Manhattan, New York, then San Francisco, California, Chicago, Illinois, Los Angeles, California, Houston, Texas, Long Island City, New York, Sunnyvale, California, Burbank, California, Philadelphia, Pennsylvania, and Santa Clara, California. And the article concludes by saying, unless the Fed aggressively begins cutting rates in March, building owners' ability to obtain financing for previous loans will have trouble rolling over that debt. Says this will only mean regional banks with high exposure to CRE space could face a tsunami of credit losses over delinquent CRE loans. So, this fed in really well with the first article I shared with you from Reuters about the banks fearing this onslaught of souring loans means they're not being paid. And the last article, again, to bring this full circle about what's the Fed going to do in response what is the Fed going to do in response to tomorrow's CPI release? And you can there's a huge amount of experts and analysts out there, and many of them disagree about what impact the CPI numbers will have. Is the Fed going to implement rate cuts starting in March? Is the Fed going to wait and see? And is the market overpricing in or over exuberant? Expecting the Fed to immediately start cutting rates. So this says Thursday's inflation report is from CNBC. Thursday's inflation report could challenge the market outlook for big Fed rate cuts. It says economists expect that inflation nudged higher in December, a trend that could call into question the market's eager anticipation that the Federal Reserve will slash interest rates this year. So they're expecting inflation to tick higher. So the story, the line of BS that we're being fed that, hey, inflation's coming down, it's all under control, there's going to be a soft landing, is probably not going to be borne out by the actual data. It says the Consumer Price Index, a widely followed measure of the costs that folks pay for a wide range of goods and services, is projected to have risen 0.2% in the final month of 2023, or 3.2% for the full year, according to the Dow Jones. It says Jack McIntyre, portfolio manager at Brandywine Global Investments, he says, quote, the market seems to have gotten excited that the Fed's going to have to do more than what the Fed thinks in terms of rate cuts now. The market got ahead of itself, end quote. As I believe the markets were roaring higher again today. Didn't see any real good economic news to support that. There's it says a wide gap between what the Fed has indicated in terms of rate cuts and what the market is expecting. If inflation data such as Thursday morning CPI release and Friday's producer price index don't show stronger inflation progress, meaning the inflation is coming down, that is liable to cause more volatility in a year when stocks have already gotten off to a rocky start. So tomorrow's going to be an interesting day. I take all this stuff with a grain of salt. You can get so much in the weeds on listening to all the different commentators, and then they parade out, the Fed heads to talk about, what they believe. At the end of the day, we have to boil this down to our personal situations, our day-to-day life. And all of this points to shoring up your financial position, working on your credit score, paying down debt. If you can, start your own business, start a corporation or an LLC, start a side hustle. But if you're going to do that, do it smart. Do not take out debt, leverage in, and go and pay as you go with regard to starting a new business. And with that being said, I hope all of you have enjoyed the content today. I'll be going to get my usual 1-hour workout this afternoon for an hour. We discuss physical fitness on this channel every day. Please take it seriously. Please get your steps in. Do your walking. Start doing some strength training. I do see some comments on most of the videos about people stepping up their routines and getting serious about physical fitness. And again, do not disregard the diet component. It is so super integral to the whole process. You will not, again, I'm not a dietitian or a doctor or a nutritionist, but in my experience and from my opinion, you will not lose weight and see results. Even if you're working out in a very strenuous routine, you will not see results if you don't also have the diet component under control. Get the water in. I'm back to doing my 1 gallon of water a day. With that being said, all of you have a great night. I'll see you all on Thursday. Okay? Bye.